Today, I want to share the remarkable story of an extraordinary retail trader. When I say ordinary, I mean an individual who didn't venture into creating an investment fund following initial institutional trading. This person, much like many of us, began their investing journey in the stock market and persevered, ultimately achieving substantial profits. Before I delve further, let me clarify that I'm excluding individuals like Warren Buffett from this discussion. While Buffett achieved great success as a young retail investor during his teenage years, he later went on to establish highly successful investment partnerships, which is what he's primarily known for. Interestingly, Nicholas Darvis's primary profession was as part of a dance troupe. Within a mere 18 months, he transformed a $36,000 investment into an astounding $2.25 million. How did he accomplish this feat, you ask? Well, stay tuned. I'll reveal the fascinating details. Darvis's interest in the stock market was piqued after being offered 6,000 shares of a company named Brilund as payment for a performance. 2 months later, Darvis was reading the newspaper when he was astonished to see that Brilund was listed at a price of $190, netting a profit of $8,000. Energized by the windfall, Darvis developed a unique trading strategy known as the Darvis box theory. This technique focused on stock price movements and created boxes, or price ranges, within which a stock's price oscillated. When a stock price broke out of this box, it signaled a potential buying or selling opportunity. Darvis noticed a troubling trend. Although he had occasional wins, he consistently lost money over time, often influenced by tips from his friends. His gains were often wiped out, and he even ended up losing more than he initially made due to commissions and other costs. Frustrated by this cycle, Darvis decided to take matters into his own hands. He penned down a few rules for himself, recognizing that he needed a systematic approach to trading. During this time, Darvis also felt the need to trade every day, always on the lookout for the next opportunity. However, he eventually realized that action does not necessarily lead to progress in the markets. Often, if he had simply stuck to his original purchases, he would have yielded a much higher return. One day, Darvis believed he had found the stock that would make him wealthy. He was convinced it would jump 20 to 30 points at any moment. Darvis piled as much money as he could into the stock, buying 1,000 shares at 52.14 with leverage. However, to his dismay and confusion, this seemingly perfect stock started plummeting. Darvis ended up crushed by a $9,000 net loss. He found himself on the brink of bankruptcy. He was stunned the stock Bruce on the NYSE had come to a halt. Darvis had his entire capital invested in Bruce. A manufacturer had been aggressively buying Bruce shares to gain control of the company. The short sellers were forced to cover their positions, leading to volatility. Now faced with a choice, Darvis could sell his shares at $100 each, effectively doubling his initial investment of $60,000. He decided to hold off for the time being. The short sellers were growing more desperate to cover their positions, and Darvis sensed an opportunity. Darvis ended up pocketing $295,000. Nicholas Darvis continued his trading journey with remarkable success, gradually building up his capital to $500,000. In due time, his trades yielded profits that totaled over $2 million, which would be equivalent to $19 million in today's currency.